Hello, everybody. Welcome to the presentation of Altamir's half-year results. Let me introduce Maurice Chéniaud, Chairman and CEO of Altamir Gérance, and Eric Sabia, CFO of Altamir. Maurice?
Thank you, Claire, our investor relations head. Good morning, everyone. Good afternoon for those who are away. Let's start, as usual, with a view on the European private equity market. As you can see on slide page 10, the activity in terms of buyout value was significant in the first half of 2022, with 235 billion worth of transaction, almost half of the record year of last year, and that is unexpected, I would say, due to the fact that there were a number of deals in the pipeline at the end of 2021. Moving to the divestiture, the exit value, again, the number looked very significant at 97 billion, which is a significant number. However, you should take into account the fact that these are only exits through the mergers and acquisitions, and obviously last year we had a very strong IPO market, which was closed this year, so that number doesn't represent the drop in volume in terms of exits. So moving to the significant events for the first half of 2022 for Altamir, the NAV is down by 2.7%, taking into account the dividend which was paid in May 2022. However, the EBITDA growth was 14.9%, almost flat compared to the first half of 2021 at 15.4%. We made 85 million worth of divestment, less than the 328 record year of last year. 5 new investments versus 10 in H1 2021 for 95 million compared to 195 million in H1 2021, and our cash position at the statutory net level was flat compared to the end of 2021 at 157 million. So moving to slide page 14, we represent, so you can see that in terms of divestment, 85 million in the first half. Obviously, you cannot compare with the 636 million of last year, and these 85 million were mostly done through partial exits because we had only 2 full exits, Atenti and Huarong, which was a loss. However, in terms of partial exit, I am pleased to say that the most significant event is that due to the great performance of Tom Group, they were able to repay 40% of our investment 18 months after the investment. And you had a number of partial exits, which totaled 85 million. So moving to new investments, again, 95 million obviously is very far away from the 369 million of the full year of 2021. However, compared to the previous year, 95 million in the first half is a very significant number. And this 95 million were made for 5 new investments, 3 in the tech and telco, Altamir alongside Apax 10 LP and EcoOnline, again, alongside Apax 10 LP. These 2 investments are in the same area of software for ESG purposes. And there was a significant event, which means for the first time we made a co-investment alongside AG Capital, because as you will recall, we have decided to diversify our partners, our fund managers, through the Altaroc process, And since Altaroc invested in HG Capital, they offered us an opportunity to co-invest alongside them in a very large software company. So we invested 12 million in that investment. And there were one investment in consumer, 4.5 million in a whiskey producer of high-level whiskies, and a large investment alongside Apax Mid-Market 10, Opteven, for 44.5 million, a European fast-growing platform in mobility insurance products and services. And in addition to these 5 new investments, in the divestiture process and reinvestment process in Marlink, we had the opportunity to purchase through a secondary transaction, to make a co-investment, an additional co-investment in Marlink for 5.2 million. However, that amount was almost offset by the fact that we had overstated our investments in Odin Group and T-Mobile in our previous disclosures. In addition to those investments in companies, we made significant investment in funds, and mostly in Altaroc Global, 9.2 million to fund 5 fund investments and 2 co-investments, and in Apax Digital and Apax Development. So on top of this 85 million of new investment, we have 10.4 million of follow-on investments, mostly to back performing companies to either make significant acquisition or to accelerate their development. All this activity translated into a 2.7% decrease in NAV. As you can see on the chart on page 19, the NAV, which was 13,781 euro at the end of December 2021, was 13,564 euro at the end of June. If you add the 1.13 euro, which was paid in dividend, that translates into a 2.7% decrease in NAV. In order to explain that decrease, I transfer to Eric, who will make the bridge between December 2021 and June 2022.
Hello, everybody. I'm going to begin with the analysis of the H1 2022 NAV bridge, as was mentioned on page 20. As you can see, the value creation is negative over the period at minus 10.4 million euro. It can be split between a positive 25 million euro on unrealized gain and a negative impact of 35.2 million euro on unrealized gain. We will see in a minute how those unrealized gains could be split. At the unrealized gain level, it is nevertheless worth mentioning the positive FX impact of 20.7 million euro on realized gain, mainly linked to the evolution of the dollar-euro over the period. In connection with the decline in the value creation, we have a positive effect of the carried interest provision, so that all in all, the portfolio declines only by 4.1 million euro, taking into account the value creation and the decline in the carried interest provision. In the meantime, the NAV has been reduced by 17.7 million euro, covering all our direct and indirect operating expenses. And the next item is the financial result of minus 16.2 million euro, which is linked to the decline of the IDO fund in which we have invested our short-term treasury. And after the 41.3 million euro dividend paid at the end of May this year, as mentioned, €1.13 per share, we reached the final NAV of 1,301.4 million euro. Page 21 on the next slide, we can see the split of the value creation by sector. The TMT sector is declining by 53.3 million euro in relation with the strong decline of the TMT values on the stock market. The best example is Southworks, which is quoted and has declined by 37 million euro over the semester. The other sectors are all positive, with almost all companies having positive value creation. The only few ones who declined are very specific. For example, Baltic Classified Group in the service sector is a company whose activity are in the Baltic region, which is currently impacted by the political situation in the area. On page 22, we have the value creation analysis on the unrealized portfolio. On page 22, the graph on the left is the detail of the value creation in terms of unrealized gain. The EBITDA growth had a positive impact of almost 235 million euros. Unfortunately, the change in the multiple totally offsets this strong effect, impacting negatively the value creation for 290 million euros. The next two items balance each other, and the accretive dilutive instruments has a positive impact of 20 million euros. To summarize, had the portfolio not been impacted by the multiple, the value creation would have been strongly positive, reaching almost 250 million euros, which is almost a 17% return on the December 2021 portfolio NAV. The chart on the right represents the portfolio bridge over the year. I will just highlight the good level of investment, even it does not totally balance the sale that occurs over the period. Mainly the strong and the main exit of Marlink, which was a very big investment for Altamir. Moving on to page 23, we present you the portfolio at cost. The portfolio at cost is increasing, and compared to the pro forma value, which includes the deal that were signed but not closed, of 831 million euros at the end of last year, Altamir has managed to increase this value to 869 million euros at the end of June 2022. It now stands almost at the statutory net worth. This is a KPI we track very carefully, as the level of invested capital is the only way to fuel future growth of the portfolio. On page 24, we present you the value creation. The split of the portfolio valuation. It is quite stable at the end of June 2022. The share of the portfolio at cost is almost stable. This is linked to the new company we keep on buying. The company valued at their quoted price is going down, mainly because of the decline in the stock market over the period. And the portfolio valued at fair value, where 82% at the end of December, it now stands at 87%. With 82% of those company valued using transaction multiple. Maybe Maurice, you want to comment that?
Yes. So, due to the fact that the stock market was sharply down in the first half of 2022, we would like to outline the fact that the reason why our fair market value are less impacted than the stock market is the fact that according to the IPEV guidelines, when we value non-listed investment, we use usually comparable multiples for listed companies, as well as comparable multiples of recent transactions. And usually both are weighted 50-50, 50% for the stock market valuation and 50% for the comparable transaction multiple. So obviously, since the transaction multiple are less volatile, that explains the fact that the impact of the stock market decline is less marked in private equity portfolio than it is on the stock market. So out of the 87% which are valued using comparable, 82% are using both listed companies comparable and transaction comparable. So you could expect that if transactions valuations go down in the new transaction, that we will have a longer term effect of decline in multiple going forward. So we can continue with the uplift, Eric.
Yes. So on page 25, we present you the uplift. It is not really worth discussing this page as the uplift is not meaningful over the period. Moving on to page 26, we present you the commitments of Altamir. They almost stand now almost at 800 million euro, given the new allocation 2022 and the 254 million euro commitment we've made over the period in Apax 11 LP. Referring to the previous allocation we have made in 2019 of 750 million euro, which was the allocation, which has been invested in the different funds you can see in the list. 512 million euros are still outstanding, mainly in the Apax Mid-Market 10 and Apax 10 LP funds. We have also included in that list the 90 million commitment made in the 3 other rock funds, out of which 78 are still outstanding. And in the previous allocation made in 2016 of 500 million euros, almost everything has been called at the end of June, with only 30 million of outstanding commitments. I will just highlight in the commitment that out of those almost 800 million euro of outstanding commitments, 146 million euro have already been invested by the underlying fund, but not called yet, as the funds use credit line at their level. Moving on to page 27, at the cash level, we have at Altamir. Sorry, I just forgot on the commitment side. Back to page 26. That on top of the 800 million outstanding commitment at the end of June, we have 107 million euro that are carried by Altamir for the Alta Rock Fund, almost 50-50 in the two HG funds, totaling 107 million euro at the end of June. Moving on to the cash slide on page 27, we have a very strong cash position at Altamir level, with a statutory net cash of 457 million euro and an IFRS cash position of 422 million euro. Those two amounts do not include the almost 91 million euro received by Altamir in July, following the sale of Marlink that were made at the fund level but not distributed by the fund to Altamir, and the 15 million euro disbursed by Altamir on behalf of Alta Rock 2020-22 that should be reimbursed by year-end. So we still have, on top of those 157 million euro at the statutory level, total credit facilities of 90 million euro which are still available, and we are actually working on to increase this 90 million euro to 120 million euro to have even more credit facilities for Altamir. I will now hand over to Maurice, commenting you the highlights.
Thank you, Eric. So moving to the significant events during the period on page 28. First of all, we would like to stress the fact that the portfolio has very limited exposure to Russia and Ukraine, and that the Marlink transaction, which was announced almost 18 months ago, finally took place at the end of June, and that in part of this transaction, Apax had decided to reinvest in the deal for 33.6 million euro. And as I mentioned earlier, we took the opportunity to make a secondary transaction to invest an additional 5.2 million as a co-investment. Moving to the portfolio on page 30, you see that the portfolio comprises 68 companies for a fair market value of 1,370 million. 24.1% are direct investments, and 75% are investments through the Apax funds, 43% with the Apax French funds, and 30% with the Apax LLP fund. On top of that, we have the fund investment in Apax Digital, Apax Development, and Apax Global, which represents 2%. Looking at the portfolio on page 31, you see the diversification by sector, with the tech and telco representing almost half of the portfolio in fair market value, by vintage, which is fairly distributed, which would allow for divestiture, obviously, when the market is more ready, and by geography, Again, here the portfolio is presented by the location of the headquarters, but since more and more companies are very international in scope, that doesn't reflect the exact geographical scope of our portfolio companies. On page 32, as you know, the strategy of Altamir is to back fast-growing companies, and the way to reflect that is that we have always computed the EBITDA growth of our portfolio companies compared to the non-financial companies in the CAC 40, and you see that in the first half of 2022, our companies are overperforming in terms of growth these large corporations. On page 33 and 34, we give you a breakdown of portfolio growth by sales growth and EBITDA growth, and you see that 82% of the portfolio at cost exhibited positive sales growth, with 20% exhibiting more than 20% sales growth. And on page 34, similarly, 86% of the portfolio at cost exhibited a positive EBITDA growth, and 35% more than 20% EBITDA growth. On page 35, we give you a sense of the average EBITDA multiple of EBITDA, and you can see that since not all companies are valued using EBITDA matrix, but 81% of the portfolio in fair market value does, that the multiple was at the end of June 14.2, so rather similar to the end of December 2021. And in terms of debt multiple, again, very stable at roughly 5.2, 5.3 times debt multiple. Moving to page 36, you see that the 20 largest investments represent 75% of the fair market value. And again, if you look at through, only 2 companies are valued below cost. Antoria at 50 million compared to 54 million of cost, and for reasons that I will explain later on. And Expereo, which is the reinvestment which we made alongside the new owner and at the new price, and due to the drop in multiple, while the company is performing very strongly, we are slightly below cost. Otherwise, all the companies are valued at cost or above cost. To give you a snapshot on the portfolio, the 20 largest companies, Infovista had a very strong year. The company is now completely focused after the divestment of the global enterprise business. So now it's a pure player in global networks activity with strong revenue and EBITDA sales. Destiny and the company is down in terms of value due to the drop in multiple. Similarly, Destiny, very strong performance, very strong growth. All the indicators, the KPIs are positive, but the company is down due to the drop in multiple. The story at Greatech is slightly different. Growth in sales, drop in EBITDA due to the fact that the company is investing actively in terms of preparing for the future, and that its mix of products was unfavorable in the first half. But we see that as a short-term event. Odin Group is a Dutch provider of managed IT and cloud services. The company is valued at cost due to the fact that it is a recent investment. The company has suffered from one of its divisions, which is linked to the education market due to the delay for teachers to come back to work after the COVID. Footworks, as you saw, which is the largest drop in terms of valuation, But when you see the numbers, 35% growth in revenues, 35% growth in EBITDA, it's really the multiple which have come from the roof to the bottom, and again, a short-term event. Marlink continues to perform very strongly, and we are very pleased to the fact that we have been able to reinvest significantly in the company and to have been able to buy a secondary position, which means that today our investment in Marlink is at 40 million roughly. Odigo, when you look at the metrics, revenue down 6% and EBITDA down 55%, you would consider that we have a problem situation, but that is not the case. The reason for the drop in revenue is the fact that due to COVID, H1 2021 was exceptional in terms of revenue, and in terms of EBITDA, as you know, Odigo is a story of a transformation from a licensed business to a SaaS business, and the decision has been made to accelerate that transition, and we expect at year end to have 80% of the clients to have moved to the new version versus our plan of 50% initially. So therefore, we are investing heavily in the business, and that explains the drop in EBITDA. Again, very well managed business. Expereo, again, down due to multiples, but 13% increase in revenue, 17% increase in EBITDA, no issue there. Paycor continues to perform very strongly, US provider of HR and payroll services, and Vocalcom is doing fine, but not exceptionally well. AAD, which is a worldwide leader in biotech ingredients and related services for wine, food, and beverages. Very strong performance in H1 2022, and the company is going to resume its acquisition program. Antoria, which is one of the two companies which is valued below cost, as you will recall, Altamir was a problem situation, and in the last 18 months, a tremendous amount of work has been done to completely change the management team, which is now in place and proving to be, the new management team proving to be quite up to the task. We had to restore the reputation of the firm with its brokers, and that again has been achieved, and the churn is now at a reasonable level. However, new product lines have been launched, and we have to prove in the second half of 2022 that these new product lines can generate increased sales. That is open. And finally, major action has been taken to reduce cost. This explains the 21% EBITDA growth during the period. Crystal is a recent investment with a view to consolidate the IFA market, to consolidate independent financial advisors, which is a very fragmented industry. And since the Apex investment 15 months ago, 17 acquisition build-ups have been made, and the management team has been strengthened, as you can see, with a new CFO, head of business development, M&A manager, CDMO, CTO, chief compliance officer, and obviously these investments in structure obviously have an impact on the EBITDA. Assured Partners is again a US leading insurance broker, and the strategy is again to consolidate a very fragmented industry with and companies performing very strongly both in terms of revenue and EBITDA. Authority Brands is a US leader in franchising of personal assistant services, again very strong performance, and Trottoir and Dixie, a European leader in route-based sanitation services for portable toilets and sanitary equipment, again very strong performance. Tom, very pleased to say that the company is performing very strongly. As you can see, 48% revenue growth, 54% EBITDA growth, due to the fact that we compare ourselves when last year 39% of the stores were closed, when this year all the stores were open. And the company not only is generating very strong EBITDA, but very strong cash, which allowed, as we said earlier, the company to repay 40% of our initial investment, and to repay 50% of the vendor loan, which was raised at the time of investment. Snacks development is the European producer of private label savory snacks. The company is suffering from very strong increases in prices of its raw materials, but the company has been able to transfer these price increases to the client. And because the private labels are obviously cheaper than national brands, the company is performing strongly in terms of revenue and EBITDA. And finally, in the healthcare sector, Montalbetter closed a transforming acquisition, buying the number 2 competitor, and that explains the revenue and EBITDA growth, while the organic was slightly impaired by some therapies being absent, but we expect this to be short-lived. And finally, Candela, a leading global aesthetic device company, had a very strong first half, again, very satisfactory. As you can see, the portfolio is very resilient, and we have only covered 20 companies, but I would say most of the other 48 companies have similarly very great performance. Moving to page 49, we compare Altamir NEV performance compared to LPX Europe, our comparable index. And as you can see, apart from last 12 months, where we are behind our peers, we outperform over 10, 5, and 3 years the LPX index. And on page 51, you see that our dividend policy of paying 3% of NEV due to the discount at which the share is trading provides a yield of 4.4% roughly every year. And on page 52, we provide you an analysis of the total shareholder return. And again, Altamir outperforms over 10, 5, 3, and 1 year all these 2 comparables, the LPX Europe Index and the CAC Mid and Small. In terms of objectives, if you recall, we changed our policy in 2021, but instead of providing you with 1-year objective, we gave you an average 5-year objective, and we are targeting 170 million per year on average of new investments and follow-on. And as you can see in H1 2022, we are well on our way to achieve that number. In terms of divestments, 230 million per year on average. We are behind at 85 million, but I remind you that we did 636 million last year. So if we average over 2 years, we are well ahead of our target. And finally, in terms of the EBITDA growth, which should give us the multiple and the IRR that we are looking for, we are shooting for 7% average EBITDA growth on an organic basis, and 14.9 is both includes M&A activity, but so we are well on our target. To conclude this presentation, I would encourage you to invest with Altamir because we have a unique value proposition. We have a growth-driven strategy. We have a policy of shareholder return, both through a dividend policy and an attractive growth of our share price. A low intrinsic risk profile because we have well-diversified portfolio by sector, geography and maturity, reasonable leverage in the portfolio, conservative valuation policy that you can see with our uplift chart, rigorous cash management processes, and no structural debt at Altamir level. We have a committed and experienced manager, and finally, we have a efficient vehicle under certain conditions. With all that, we thank you for your attention, and don't hesitate to ask questions. And the three of us, Claire, Eric, and I, will be happy to answer all your questions. Have a good day.
Thank you.
Bye-bye.
Bye-bye.